Awesome. So we are now live on our various social media channels. Again, as a bit of housekeeping, if you are joining us live on Zoom, you can use the Q&A to post questions as we go throughout the webinar. If you're following along on any of our social media channels, you can post a comment below and our team will relay those comments and feedback over to the live session, and we'll do our best to answer them as we go throughout the webinar. If you're seeing this in a replay, you can post your questions and our team will answer them in the comments and feedback section. So today's topic is on GST, HST, which can be a little bit confusing and overwhelming to people because it is a little bit complicated. Um, the key concept when it comes to GST, HST is you don't pay GST, HST, you manage it. So obviously you are going to collect GST, HST from your customers. You're going to pay it on various expenses, and you're going to pay the government some portion of what you've collected. How much you pay and when you pay is where things start to get a little bit confusing. But what is important to know and understand about GST, HST is that it can become a profit center for most service-based professionals. And that's because there are a couple of different ways that you can choose to remit. And either way, you're not paying the government 100% of what you're collecting. You're at the very least getting credit for the GST that you've put on or you paid on various business expenses. And that's how you calculate the long method. You just take what you have collected from your clients, you subtract what you've paid on the GST you've paid on your various expenses, which we call input tax credits or ITCs, and the rest is what you pay the government. So in that situation, you're not actually necessarily making money with GST, HST, but you're also not out 100% of the GST, HST that you've collected. And to the point of managing it as opposed to paying it, you're not paying it because you're taking the money that you collected, you're holding on to it for a bit, which gives you potentially access to the time value of money because you could invest that, generate a return. Very few people do, but you could, and then you're remitting the delta between what you've collected and what you've paid on your various expenses back to the government. But there's also another method of GST HST called the quick method of GST HST. And it's the method that we recommend for the majority of service-based professionals. And here in Ontario, and I say specifically here in Ontario because rates do vary with GST, HST based on all the different provinces. But here in Ontario, with the quick method of GST, instead of taking what you've collected and subtracting what you've paid and remitting the delta to the government, you actually just pay the government a percentage of your total revenue, including HST. So you'll pay 7.8% of the first 30,000 and 8.8% of anything over $30,000. And what that means is that CRA is effectively estimating what you would have spent on input tax credits at, the delta between the 13% and either the 8.8 on anything above 30 or 7.8 on anything below 30,000. And the reality is for most service-based businesses, that's going to be a higher estimation than what you've actually paid in GST, HST. So then you end up with something called sundry income, or money that you've effectively made by charging and remitting GST, HST. And for this reason, we often recommend to clients that even though you're not obligated to sign up for a GST, HST account until you've collected $30,000 in revenue, we recommend that you sign up the minute you start generating income because it is a potential profit center for you if you are on the quick method. Now, like I said, GST, HST can be a little bit confusing because, first of all, it's not just one tax, it's actually two. You've got goods and services tax, which is the federal sales tax, and then you've got PST, which is the provincial sales tax. And in some provinces, we have harmonized sales tax, which is basically just the GST and the PST combined. And in many provinces, including Ontario, we have harmonized sales tax, which means you're only worried about the 13%, and you're not worried about the delta between the 5%, which is the federal rate, and the 8%, which is the provincial rate. You're just paying the 13% or charging the 13%, and you're remitting whatever you're remitting, and the Fed worries about distributing to the province, which makes it a little bit easier for you. When you get into certain provinces that are not harmonized, it can be a little bit more work for you, but still relatively straightforward once you've done a few rounds of this. But if you thought that that was the end of the complexity, I wish that that were the case. It does get even more complicated because the timing of your GST HST return may be different from the timing of your corporate return. It could happen to be the same, it could be different. By default, what's going to happen is by default, when you set up your GST HST account, they're going to set you up on a December year end almost always. They're also going to set you up as a quarterly filer, and they're going to sign you up with the regular HST remitting method. So if you want to elect for the quick method of HST, you actually have to file an election. If you want to elect to file annually instead of quarterly, which we do recommend because, you know, if you can file one return instead of four, that's going to save you some time and or some accounting fees. Then you need to make those as elections after you set up the account. It's all relatively simple to do. Most of it can be done online through the CRA portal, but these are steps that you have to actually take because the default is, like I said, going to be a December 31st, and you may want to change that if you have like a January 31st fiscal year and January, February, March, who knows what your year end is. Typically, you want to make your GST deadline the same as your corporate deadline. Now, you can, when you set it up, change the year end date. It can also be changed down the road. You have to have a reason for it, but it can be. And again, if you thought that that was the end of the complexity, it continues from there because the question now becomes, well, do I need to charge HST or GST and PST on the services that I provide? And it's important to note that there are effectively three types of services. You've got regular services, which would be subject to GST HST, which is applicable for most IT consultants. You've got zero rated, and an example of this would be there are certain industries which are zero rated, but also if you have a client in the US, that's technically subject to GST HST, but zero rated. And that's important because with zero rated, you can still claim your input tax credits or the GST HST that you've paid. And so in the situation where you have a US client or a client outside of Canada, you would actually want to be on the long method of HST because zero minus a number turns into a refund, whereas zero times a number is still zero. So in most consultants who have regular HST eligible services, then you want to be on the quick method because that calculation of 7.8% or 8.8 typically results in several thousands of dollars in tax savings by electing for the quick method. Whereas if you have exempt zero rated supplies, then you're going to be better off with the long method because again, zero minus a number results in a tax refund, whereas zero times a number just results in you paying nothing. The other type of classification I mentioned, there's three. There's the regular, there's the zero rated, which we talked about, but there's also exempt. And exempt industries, things like doctors and certain industries are exempt from HST. Now, the difference between exempt and zero rated is that if you are exempt, you cannot claim input tax credits. So you're not eligible for a HST payroll account. You wouldn't, or not HST payroll account, an HST or sales tax account. So you wouldn't even set one up because you're not going to be able to claim input tax credits on that. But Again, if you are a regular IT consultant, you've got clients who are outside of Canada, then you want to be on the long method. Now, again, if you think that that is the end of the complexity, it is not. It gets complex because now you know, okay, should I be using the long method? Should I be using the quick method? Am I zero rated? Am I exempt? Am I regular? Um, but now you need to know, well, what rate do I charge? Because the rate by the rate for each province is different. Um, and the Fed rate is 5% across the board, but the provincial rates are different, which means even in the HST provinces, you can have different rates from one province to another. And then, of course, in the provinces that aren't harmonized, you obviously have a different sales tax like QST or something like that that you're going to have to deal with. So now you need to determine, well, what do I charge my client? Am I charging them HST? Am I charging the rate based on where I'm located? Am I charging them the rate based on where they're located? And the answer to that is you're charging based on where the benefit of the services reside. Now, there are a few exceptions to that rule, but we're probably not going to go into all the different exceptions today. What I can tell you is, generally speaking, as an IT consultant, it's based on where the benefit of the service resides. So that fundamentally means if you are in Ontario and your client is in a different province, you charge based on where that end client is located. And what can get even more complicated is sometimes you're at a location in maybe Montreal, but the end client is a large multinational whose head office is still in Ontario, so it's still based on Ontario. So as you can see, it can get a little bit complicated when it comes to determining, what sales tax rate that you should apply. Now, if you're in doubt and you're wondering whether you're eligible for any of the exceptions or what rate that you should be charging, feel free to reach out and connect with us. I know that a lot of times people will rely on their recruiter or their end client to determine the sales tax rate. Um, but we have seen in more than one occasion, um, both recruiting firms and end clients get that incorrect. And like I said, 9 times out of 10, it's going to be based on where your customer is located, not where your business is located. And the most common mistake we see is that people will charge based on where they are located, not where their customer is located. And the easiest way to sort of remember this is to think about when you buy something online, you're paying sales tax no matter where you're buying it from, whether you're buying it from Calgary or you're buying it from Montreal or you're buying it from somewhere on the East Coast, you're still paying 13% because it's based on where the benefit of the service or product resides, which if you're buying a product here in Ontario, it's going to be subject to Ontario sales tax or HST at 13%, not based on where the supplier of that product or service is. So we've talked a little bit about taxable, zero rated, and exempt. I know that can be a little bit complicated, but once you figure that out, that doesn't tend to change. So that's not really one of the most overwhelming things. The biggest thing that we often see is that clients are often late with GST, HST, and GST, HST penalties are up there. They're not as high as payroll, but they can be up there because, again, much like payroll, the government considers this money that's held in trust, and that it's not your money. It was your clients that had given it to you, and you're holding on to it on behalf of the client, similar to payroll. So if you don't pay your GST, HST, they're going to be on you pretty quickly, and they're going to be sending you to collections and all sorts of not so fun steps there. Now, why this can get a little bit confusing is because even if you sign up or you elect for annual filing, you only have to file once a year. But after your first year of filing, what's going to happen is CRA is going to want installments towards your next year. So let's say you get to the end of the first year and you owe $20,000 in GST, HST for that first year. So you're gonna have to pay that $20,000. In addition, they're probably going to estimate that your GST, HST for the next year is going to be 20,000 based on the current year. And so they're going to break that into, 4 installments of $5,000 a piece and expect you to pay that every quarter to make sure that they get their cash flow. Now, if you get to the end of the year and you've made all your payments and you actually only owe 10, then you should get a refund of the other 10. So you will get the money back. In addition, sorry, bear with me 1 second. Oh, good. Okay, awesome. Thank you. Sorry, I got a repair guy going here. Yeah, feel free. So you will get the difference back. And of course, if the installments told you to pay 20, but you end up owing 30, you'll owe the additional 10. There won't be any interest because you didn't pay more in installments in your quarterly installments. But if you don't pay by the payment deadline, then they will charge you interest for that additional $10,000. Now, finally, when it comes to installments, if you don't make your installments and you get to the end of the year and you do not owe, there is no penalty for not making those installments. And we often see that when clients maybe take a full-time gig or stop consulting for whatever reason, and cash flow is tight. I'll say to them, yes, you're free to not make your installments, but of course, if you ever come back to contracting, what I recommend in that situation is just remit whatever you collect, and then you'll get a small refund. And that way, for sure you're not going to be hit with any interest and penalties. But like I said, if you say, okay, I'm not going to make any installments, and you make no money for the first 6 months, but then you make money in the second 6 months, and you didn't pay installments, you're going to owe interest on the installment amount that up to the total amount of taxes owing. Even if you pay by the filing deadline and the payment deadline, if you haven't made the installments, they are going to charge you interest from those installment dates. So like I said, GST, HST can be a little bit confusing. However, it can also be a profit center. And once you get it all figured out and sorted, it is pretty straightforward. Now, as I did mention earlier, you do not need to charge GST, HST, or register for GST, HST if your revenue is below $30,000 over 4 consecutive quarters. However, as I said earlier, it's a profit center, a potential profit center. So we do recommend, even though you're not obligated to register for GST, HST, that you should. There are a couple of exceptions to this recommendation. And that's if your industry that you're in is price sensitive, or charging the extra sales tax could impact the amount of revenue that you could generate. Now, typically for IT consultants, that is a non-issue because what's going to happen with your end clients is they are going to be larger businesses, and larger businesses are not eligible for the quick method of GST. That's only eligible for businesses that are under $400,000 in top line revenue. So if you're over $400,000, unfortunately, you're stuck with the long method no matter what. And with these larger end clients or recruiting firms, they're well over $400,000, which means that there is no cost to paying you GST, HST. And what I mean by that is they have their own GST, HST that they've collected, and what they're paying you becomes an ITC and just reduces the amount of money that they give the government. So whether they give it to you or they give it to the government, it's not changing their profits in any way, shape, or form. So that's, generally speaking, I said in the IT industry, it's a no-brainer. The exception is only if you're providing services direct to consumer, and charging GST, HST would impact your revenue and your profitability. Is that so? And hopefully that's a little clearer than mud. So core formula here, you're going to collect GST, HST. You will have paid GST, HST on your various expenses, and you're going to owe the government either the net tax between those two or an even lower amount if you are on the quick method. If, core concepts where you can go wrong is missing expenses or input tax credits. Even if you are on the quick method, there are a few input tax credits that you can claim, and those are on fixed assets. So things like computer equipment, office furniture, those types of things. So if you pay GST, HST on those types of things, you can still claim them. Purchases of automobiles, big assets like that, you can use the quick method and still claim ITCs on those fixed assets. The other big mistakes are obviously setting it up wrong, just going with the default, either having a year end that doesn't match your fiscal year end, having to do 4 quarterly returns instead of 1 annual return, which will cost you more in accounting time, using the long method when you'd be better on the quick, or using the quick when you'd be better on the long, whichever the case might be. Of course, tracking the individual expenses if you are on the long method and breaking out the GST, HST. And this is an important concept to know and understand as well here, is that when it comes to your bookkeeping, if you're on the long method versus if you're on the quick method, the way you track your expenses is actually different. So if you were on the long method, the way you'll track your expenses is you would have the pre-tax amount as the deductible business expense amount, and the tax would actually go to a separate category to reduce the amount of sales tax that you pay. Whereas if you're on the quick method, you actually just deduct the full amount, including the tax. So in addition to making money on sundry income, you actually reduce your taxable income because you have 13% more in deductible business expenses because you're actually able to claim the sales tax as part of the general expense. So that's important to know. Eligible expenses are things like software, office supplies, commercial rent, professional services. Things that would be exempt are like personal rent, medical services. Things that would be zero rated would be things like groceries. It can get a little bit complicated when it comes to goods. Different provinces are going to have different rules on when and when not to apply sales tax. And that's where it can get even more complicated. I'm not going to delve into that now because, well, we don't serve product-based businesses. We only do service-based businesses. So unfortunately, if you are someone finding us on YouTube or one of our social media channels, you may need to do an AI search on that. Timing rules. This is also a little bit complicated. So you have to make your claims in your specific time period or reporting period. In addition, if you made a mistake and you need to go back and amend a return, you can amend a return if the revenue has changed, but you cannot amend a return if only your input tax credits have changed. If only your input tax credits have changed, you'll have to claim them in the next eligible period. So that, again, can be another timing issue and something to be aware of. So making sure that you were accurate and timely with your bookkeeping, because you might end up with a timing issue where you've missed out on some deductions. Yes, you'll still be able to claim them, but you may not be able to claim them for a full another year. And then that means you're paying more tax now, less tax later, which means CRA is getting access to the time value of money instead of you. And we want to reverse that whenever and wherever we can. Filing basics. So typically it's going to be annual. And then you are going to be due 3 months after the fiscal year end. The good news is there's no multiple deadlines the way there is with a corporate tax return. Like with a corporate tax return, they expect you to pay by 3 months and file by 6. There's none of that here. It's just 3 months after if you are annual. If you are quarterly, it's going to be in the next month after the quarter. So the timing can be different if you're quarterly. You can also potentially be monthly. And whether you're so you can elect for annual, but also based on your revenue, you may be forced into quarterly or monthly, depending upon your thresholds. So that could change over time. Obviously, if that happens, you will get a letter from CRA and you will get notifications but be aware that you could be switched automatically from annual to quarterly, or from quarterly to monthly. And again, whether you're monthly or quarterly, it's going to be due 1 month after that either month end or quarter end. Whereas if you're annual, it's going to be 3 months after your annual year end. So again, a lot to take in here. I'm not sure if anyone has any questions. I haven't seen any come through the chat yet, which means either I have knocked it out of the park and made it as clear as we can. So I'll leave it up for a few minutes in case there's some more questions, but I think we've covered everything here. And just remember that CRA takes GST, HST quite seriously. It is not a tax you want to get behind on because obviously interest and penalties, but also collections is a very real issue for people who get behind on their GST, HST. So my general rule of thumb is take what you collect and set it aside in a separate bank account. You're going to end up with able to keep some of that, but set it aside because that's not your money. You're holding that on, in trust of your end clients. And if CRA doesn't get it, they will bring the hammer down on you. So I want you to be aware of that. So, make sure you stay on top of your bookkeeping. Make sure your bookkeeping is set up properly based on the type of method you are using for filing your sales tax, whether that's the quick or the long. Track your input tax credits, even if you are on the quick method, because you're going to have input tax credits on those fixed assets, as we said. Keep your receipts, use cloud software, do all those things we always recommend. And if you run into any problems, reach out and connect with your accounting team, and we'll be more than happy to help you. And as I said, GST, HST is not a sales tax you pay, it is a sales tax you manage. And when well informed, it can be simple, and if the system is set up right, it's inexpensive and in fact a profit center for you. So it does look like we've got our first question right now. What happens is there's no revenue 1 year and there are expenses with HST. Can you still file? Yes, you can still file. Now, if you are on the quick method, you will not owe and you will not get a refund because 0 times 7.8% is 0. But if you are on the long method, you will get back whatever GST you have paid on your various expenses. So if you've paid, $1,000, $1,500 in GST, HST on all the various expenses you've bought throughout the year, and you've not collected any GST, HST, you will get the $1,500 back. Now, another thing to be aware of about the election for the quick method, it cannot be made retroactively. It has to be made most often proactively for the next year. So, if you get to the end of the year and was like, oh, I didn't charge revenue, I'll go switch back to the long method. Yes, you can switch from year to year between quick and long. You can make as many elections as you want. But they typically will not backdate it. They will typically give a grace period between 1 to the most I've ever seen is 3 months. And you can do all of this. You can make all these elections online through your CRA portal. So what I always recommend is go and try and see if it gets approved, because you'll know right away whether it was accepted or not accepted, the election. But oftentimes we're stuck in a situation where, nope, you're stuck with the either quick or long for this year, and whatever we're trying to elect for will be changed at the first day of your next fiscal year. So important to be aware of that. Not sure if there's any other questions. But again, want to thank everyone for their time. This was a relatively short session, but I think it's important. The other thing we want to make sure that, or I want to let people know, is we're going to be modifying these webinars a little bit. I'm going to be modifying these webinars. You see, we're not putting up PowerPoints. We're doing that so that we can get better content for social media, little clips and stuff like that. But as well, one of the other things I'm going to be doing is for clients who are coming to these, is we do make these free and available to clients and non-clients alike. But for clients, what we're going to do is when we have free time at the end of the session, after we get through this, like we've got another, I've got another half an hour or so before my next meeting, what we're going to do is we're going to make it so that on a first come, first come, first serve basis, I will open up a private chat room. And if you have a question that you don't want to ask necessarily in front of other people, I will make this time non-chargeable and available to you on a first come, first serve basis to encourage more people to come to these webinars and attend and participate. And it's a great way to come out and get some of your questions answered free of charge. Can't guarantee I'll be able to get all of it solved in the time that we have, but I might be able to answer some of those quick and common questions for you, even if they're ones you're not comfortable sharing in front of a general audience. Thank you for the comment that it was informative, and thank you for taking the time out of your day to join us. And with that, I will bid everyone adieu and wish you a happy Tuesday and say goodbye for now.